Hello, everyone, and welcome to LPL Market Signals. Jeff Buchbinder here with my friend and colleague Lawrence Gillum. Lawrence, we're recording early. We're a little off schedule this week because you are headed to the big LPL Focus Conference in San Diego over the weekend. So my question for you is, are you rested enough to be on your feet for a couple of days, 17 hours a day?
Yeah, I don't know that you're ever rested enough, to be honest with you. I mean, you've done this a lot. It's a big effort. It's exciting though. I guess this is going to be the biggest one ever. We were told 10,000 people total. And as someone that gets a little scared of peopling, as my daughter calls it, this is it's going to be a lot, but it should be a lot of fun too.
Yeah, I've probably been to 15, 16 of them by now. I always enjoy them. So
Yeah.
with 10,000 plus there wasn't enough room for me this year, but I plan to be back again in 2026. So have a great conference, Lawrence, and I know a number of you listening to this when we put this out on Monday are going to listen from San Diego. So have a great conference. Hopefully it's off to a great start for you. Here's our agenda for today. We will probably be a little more abbreviated than we normally are. So Lawrence, you can get back to packing up. The recap for the markets, we don't have a full 5 days of trading yet, but we are up about 2% week to date. Been an excellent week. Tariff exemptions gave us a little bit of a boost. And then I think you'd have to probably attribute much of the rest of it to just earnings, company fundamentals, certainly tied to the AI theme. Next, Lawrence is going to tell us what's going to happen at the Fed, who the Fed chair is, what the appointment of Stephen Moran means for the tenor over there in the next 4 or 5 months, I guess. So big news with the Fed lately. Next, we're going to talk tariffs. We would all love to put tariffs to bed, but we just can't do it yet. Uh, it, we are getting more clarity, but I wouldn't call it a clear picture. So we'll give you the latest kind of scorecard there, and then finally preview the week ahead as we always do. And CPI comes next week. So starting with the market recap, the again the week to date, we're up about 2%, almost 9% on the S&P year to date. Really, really tremendous. Almost 30% off the lows. So when I look at that return, it's certainly been tech led. In fact, the tech sector off the lows is up over 50%. There's a lot of AI enthusiasm there. There's also, we think, a little bit of complacency. So this market probably needs to consolidate to absorb the tariffs that are going to kick in over the next, call it 3 to 6 months, and then maybe reload for another move higher on AI and stimulus in 2026. So we might get more gains this year, but we're starting to think about I don't want to say take risk off just yet, but certainly expectations for further gains, we think it makes sense to just be prudent and maybe moderate those expectations. So that's really the story. Just getting a little bit better news on the tariff front and a strong second quarter earnings season. And here we are. We just keep going higher. I think we'll just leave it there and move on to bonds or anything else on this page you want to talk about, Lawrence. I mean, the bond market's done well. I mean, that's probably part of why stocks are doing well too. You think part of that reflects what we're hearing from the Fed, or not so much?
I think it's included in there for sure. You could actually argue that the bond market is rallying despite what we're hearing from the Fed in terms of the loss of Fed independence, et cetera. So it has been a pretty
That's right.
strong year for fixed income markets, up 4.6% year to date on the aggregate bond index. Uh, Friday's job report was a tailwind, big tailwind to bond prices last 5 day period. So we did see a lot of the core bond sectors rally. Treasury index up 80 basis points over the last 5 days. Mortgage-backed securities, who we've had an affinity for within the fixed income markets, up about 1% over the past 5 days. One thing to point out, and we're recording this on a Friday afternoon, so I'm different energy than I would be on a Monday afternoon. So I do have to call out the outperformance of the ag relative to the Euro ag. There was a lot of discussion about the American exceptionalism going away not too long ago, but we haven't seen that in the bond market. The U.S. ag up 4.6% year to date versus 1.2% on the Euro ag. So despite the scary narratives that the U.S. bond market was perhaps going to underperform its European counterparts. That just hasn't happened. So, as a primarily U.S. focused fixed income investor here within LPL, our models are primarily U.S. based. So we've participated in that U.S. rally. So that's really all I'll say on the fixed income side. Munis, except for munis continue to struggle. I still think munis are in a good spot from a valuation perspective and a fundamental perspective. There's just been too much supply and very little demand, which has kept that market weak. But I think the setup for that market is as attractive as it's been in quite some time.
Yeah, I think it's fair to say that at least so far, Treasury Secretary Scott Bessent has been successful in giving us a calm, relatively calm bond market. There have been some ups and downs, but I don't think you can complain too much about where the 10-year yield is now, and the returns we've gotten year to date. High quality bonds, 5%, give or take. The only other thing I'll mention here, we're getting little flashbacks from the copper volatility here with reported tariffs on gold imports, and then now apparently the administration is clarifying that. So we might see a situation where you get some additional volatility in gold, maybe up on the tariff announcement and then down on clarification of those tariffs. So we still like the precious metals area. Central bank buying is certainly a big reason why. Potential dollar weakness. By the way, the new Fed governor likes a weaker dollar. So there you go. There's an additional new stimulus or new tailwind that people need to start thinking about. So dollar weakness may be likely to continue in the near term, although certainly dependent on Fed rate cuts. All right, so here's the S&P 500. I mentioned that this is probably a logical place for some consolidation. This is the seasonally weak time of the year. We had this huge run. Now, I guess we broke that streak of being above the 20-day moving average, which was one of the longest ever. Now we're just sort of bumping along right at that 20-day, but pretty close to all-time closing highs as we're recording this, as Lawrence, you mentioned. It is August 8th, 2025 in the afternoon. And, RSI 14, it's kind of like a diffusion index. You want to see that under 70, otherwise you're overbought. We are at 62. And I think it's fair to say, as I wrote here on this slide, overbought conditions have reset. So that's a little bit of a more positive story than a market that just, overbought with an RSI 14 well above 70, where you would be worried about a pullback. I guess the good news is we've found a little bit of support here at the 20-day. Next support level below the 20-day we would point to would be 6,200, a nice round number. So what is that? 185 points down on the S&P 500, and then below that, we'd be looking at the February high, 6144. So there's a decent amount of support still without a major drawdown. We certainly don't expect a major drawdown, but we're very likely to get a little bit of a bumpier path over the next couple of months than what we've seen certainly over the last few. All right, so we're going back to you, Lawrence, on the Fed. So I teased it a little bit. Really interesting situation there. With the vacancy and the upcoming selection of the new Fed chair. So help us make sense of this. Does this really mean anything for rates? Do we have to wait for the new chair? How would you think about that?
Yeah, it's shifting the makeup of the Federal Open Market Committee, the FOMC, a little bit. Right. So last week we did get the announcement that an existing Fed member, Adriana Kugler, was retiring, effective today, actually. So there was an empty seat that needed to be filled. President Trump announced this week Stephen Miran, I think it's Myron, Stephen Myron, is the new candidate for that position, for that Fed governor position. So he is a noted dove. Kugler was a noted hawk. So in the realm of doves and hawks, it does look like the committee is going to get another dove, meaning that another person that wants lower interest rates. So in that sense, it does shift the makeup of the committee a little bit. That still leaves the ability for President Trump to announce replacement for Chair Powell, Jerome Powell. His term as the chairman of the Federal Reserve that ends in May of next year, where he'll likely get another opportunity to replace Powell if he does decide to step down from his role as governor. What's interesting is that his role as chairman ends in May of next year, but he can still remain on the committee if he wants to for a number of years. We'll see if that actually happens or not, or if he does decide to retire. But so bottom line, it doesn't automatically mean rate cuts are going to get enacted this year or next year. But it does increase the probability a little bit that rate cuts will happen this year. So we'll have to see how this goes through committee and how long it takes to actually get Mirren approved or not. His term, I guess, it overlaps with four more additional meetings, four more Fed meetings. So we'll see if if market pricing changes at all and we get additional rate cuts priced in. But for now, it doesn't look like the bond market is overly concerned. What we're showing here is the 10-year Treasury yield. That, the more things change, the more they stay the same. It's been in this trading range for a while, as kind of our expectations. We think it's going to stay in this range throughout the rest of this year. 4 to 4.5 is probably a likely range for the 10-year Treasury yield to stay in. To get much higher than that, we'll probably have to get these rate cuts priced out of the market. To get much lower, we'll probably have to see economic data weaken more than we expect. So 4 to 4.5 is a likely range for the 10-year Treasury yield throughout the rest of this year.
Yeah, I always say be careful what you wish for in terms of rate cuts, because to get maybe more than the market expects is going to require some unexpected economic weakness, which we certainly don't want. I guess the only other thing I'll add is, I mean, my understanding is that it's very rare for the Fed chair to stay on after their, term as chair ends. So do you think Powell will kind of follow suit and step off the board?
I mean, I think if he really wanted to get back at Trump for whatever reason, maybe there's that nugget in his head to say, I'm not going to give you the opportunity to make another appointment and stick around. But I tend to agree with you. I think it is very unusual to see a governor stick around after his chairman or chairwomanship. And so I think markets expect for him to step down and for President Trump to have another opportunity to appoint another member to the Fed.
Yeah, I don't want to have to figure out the legalities of firing a board member as opposed to firing a chair. Let's hopefully move on. I certainly expect him to step down as most do. So, well, what's interesting though is that Trump preserved optionality by appointing a temporary board member, right? After that temporary term ends, that's when presumably the chair would come in, right? Unless, I guess, Waller's already on the board, right? So if he's Fed chair, you don't need a new person to slide into that Kugler seat. Did I get that right?
That's right. So if Trump decides that Waller, who is already an existing board member, is the next person to take leadership at the Fed, then I guess in theory he could appoint another person to replace Powell, but it would make kind of that shadow Fed role a little bit more prevalent, depending on when that announcement's made. So there's a couple different moving parts there. So there could be some additional drama unfolding at the Fed. Who says Fed watching is boring? I mean, it's gotten to turn into a soap opera here recently. But there is some options for additional appointments and or not, depending on how things play out over the next couple months.
Yeah, certainly by putting in several people there while he is in office, President Trump will be able to reshape the Fed somewhat. So here you're just seeing the trough rate. Lawrence, do we still think that the yield curve should be somewhere in the sort of 50 to 100 basis points for the 2-year, 10-year?
That's our expectation. So we do think that the yield curve can continue to steepen, primarily because of a fall in the front end of Treasury yield curves. So if you look at the difference between a 2-year Treasury yield and a 10-year Treasury yield, you're only getting about 50 basis points of additional compensation for owning a 10-year Treasury yield that has 5 times the interest rate risk. So our view all along has been it doesn't make a lot of sense to own a lot of these longer maturity securities. Because of the shape of the yield curve, which we again expected to steepen further from here. But what this is showing is that markets have really only priced in about a 3.4% trough rate for the Fed funds rate, which is still higher than what the Fed has told us kind of a neutral rate would look like. And what I'm showing here is what's called SOFR. These are your secured overnight financing rates. This is just what markets expect cash rates to be over the next, call it 50 years. A lot of variability. This is regularly traded, so this changes. And we did see this rate change after Friday's jobs report. Markets had priced in a trough rate of around 3.6%. Now it's down to around 3.4%. So I do think that there's still room for this number to come down, this trough rate to come down. And if that happens, that should be one of the reasons why we see a fall in longer maturity securities. The 10-year Treasury yield has a 0.98 correlation to the expected Fed funds trough rate. So if that relationship holds, and it should, as if this trough rate comes down, that would likely bring the 10-year Treasury yield down as well. But to your point, if it does come down, it likely means the economy is weakening more than what we expect.
Yeah, certainly we don't expect recession, but you'd have to really get either a recession or a growth scare to see meaningfully lower rates. So I think, what I'm hearing from you, Lawrence, is maybe we need to get used to a 10-year yield in the fours and not think about a return to the, I don't know, mid to low threes or even the twos, where, of course, not too long ago, we spent a lot of time down there.
Yeah, that's right. I mean, I don't know that we're going to get back to zero interest rate policy, ZERP, anytime soon, despite calls from President Trump to do so. I think if and that's one of the risks that we talk about in the bond market. If we do get an overtly political Fed board that cuts rates aggressively because of political pressure and not because of the economic data, you could see the back end of the yield curve, these longer maturity Treasury yields actually move higher because of the concerns about inflation or just really the concerns about the politicalization of the Fed. So back to your saying, be careful what you wish for. So if the Fed funds rate gets down to zero again, that could mean the long end of the Treasury yield curve is going to move higher and not lower, which would have a negative impact on the economy. So lots of things playing out. So we'll have to see how the Fed reacts over the next couple quarters.
The long end is so important in terms of managing the cost to service the U.S. debt. And that's why you've heard Besson talk about caring more about the 10-year yield than the stock market. Critically important. So they certainly do not want to fight that Fed independence narrative over the next several months, which is why you're probably not going to get a fringe Fed chair, right? Or fringe. I mean, certainly Mr. Myron is a very reputable, credentialed person. He's going to get confirmed. He was already confirmed as head of the NEA, right? National or NEC, I guess, National Economic Council. So you're going to have a smooth confirmation after the Senate gets back from their recess. But they have to be very careful. They do not want the market to think that the Fed has no credibility and it's going to let inflation run away from us.
That's right.
I think that's critically important.
Yep.
In fact, I would argue probably the biggest risk to markets here over the next couple of years. So thanks for that, Lawrence. Let's move on to our favorite topic, everybody's favorite topic, tariffs. I think we're getting pretty close to the point where we can stop talking so much about this, but we're just not quite there yet. I promise I'm going to talk about a little more than tariffs in the weekly market commentary this week, which if you're listening to this on Monday, or Tuesday, you can get on LPL.com. Essentially, the main point I make in this commentary is that tariff risk is being offset by fiscal stimulus expectations, the One Big Beautiful Bill Act in 2026. So the market is comfortable with tariffs because they've got that offset, right? Now, obviously, artificial intelligence investment is an offset too. But this is just remarkable how well the stock market has handled tariffs. Now, there are a number of reasons for that. I mean, they're only like halfway implemented, first of all. Companies had to draw down their inventory, right? The inventory, when these tariffs were put in place, the inventory was not tariffed. It was already on US shores. So they worked through that. They shift some things around, right, from country to country to try to get the tariffs down. There's been negotiation. People have waited to see what the final rates would be. There's a lot of cross currents here, right? But for various reasons, oh, and by the way, international exporters have absorbed some of these tariffs. For these reasons and more, stocks have done fine. Actually, better than fine. Even the stocks that are influenced by tariffs heavily have done better than fine. And that's what this chart shows. This is a Goldman Sachs basket of stocks that are relatively immune to tariffs versus stocks that are high risk from tariffs. So certainly think about like apparel retailers as being a high tariff risk stock, and maybe a domestic bank being a low risk tariff stock, or certainly some media companies. If you look at the relative strength of this tariff immune line, went way up on April 2nd, Liberation Day, so-called, way down since. Why did that happen? Because of the 90-day pause. So people have actually, the market has rushed in to buy the stocks that are hurt most by tariffs. It's really remarkable, because that's this underperformance of the tariff immune stocks. In other words, the market's not going for tariff safety, it's going for tariff risk. And it's buying tech and AI names. So this is really just evidence of how resilient this market's been. Now, I would argue, and I do argue that in the commentary, that the market's probably getting a little too complacent. Because as you see on this slide, as of the latest data we have, July 1, only 8.9 points of tariffs were implemented. We're actually being paid. This is based on the tariff revenue coming into the U.S. Treasury. The remaining tariffs that are expected to come in, it varies. Estimates vary, as you can see here, probably between 6 and 9%. So there is more to come, but the market doesn't really care. Now, maybe the market doesn't care about inflation coming up a bit because it's temporary, but the market should care a little bit about margin pressure, about U.S. companies having to pay these tariffs increasingly in months ahead. They're not going to be able to evade these or kind of shift things around. There's only so much time where they can, see little impact. So don't want to sound too negative here, but just there's more to absorb, and that's probably what's going to give us a little bit of bouts of volatility over the next several months. We'll see. I also think it's interesting that the forecasts here are so varied. I think part of this might be because of evasion of tariffs, but the dollar is actually coming in, or uncertainty, confusion about what these tariffs actually are and what's exempt. For example, Strategist Research, their policy strategy team, thinks 14% is a good estimate for where we're going to land. But these other firms, Evercore ISI, the Yale Budget Lab, and Fitch Ratings, they think 17 to 18%. So hard to say who's right, but point we're making here is there's a lot of uncertainty, a lot still left to be settled, and we'll just have to kind of wait and see where these numbers land. So here you see we're up to 9 that's been implemented. We're going to maybe the high teens. Markets can probably handle mid-teens. I don't think the market's going to love high teens. So that's all I got on tariffs. Hopefully we can talk less about that going forward. But you got to tip your hat to Mr. Market or Mrs. Market because they are really handling this tariff implementation well. All right, let's go the week ahead, Lawrence. I'm going to go back to you. We have CPI. How worried should we be about inflation? And how much are tariffs going to affect that? I just said I'm not going to talk about tariffs anymore, and now there I just snuck it in again.
That's the big question, and we'll find that out on Tuesday. How much of an impact, or how much of those prices are getting pushed through to consumers? So we'll get July CPI data on Tuesday. The expectation, as you point out here, is we might see a slight uptick in inflationary pressures going from 2.7 to 2.8 at the headline year-over-year number, 2.9 to 3% on the year-over-year core number. So not a huge move higher in inflationary pressures, but not a fall in those inflation numbers, which we were seeing over the past couple of years. So we'll see if that's the big release next week, the inflation data, to see if in fact companies are able to price or to increase prices to offset some of these tariff charges that they're seeing. So that's the big data release. We got PPI as well, which is the producer price index, and then some additional economic data next week. But it's about inflation for the economy.
Yeah, it's even though retail sales is important, the inflation data probably will get more attention. I mean, consumer spending is slowing. You see it in the jobs market, right? And there are a number of other signs that consumer spending is slowing. So we would expect to get a little bit of evidence of that in that retail sales report, which is that's on Thursday. Is that right? No, that's on Friday, actually. Coming on Friday, along with import-export prices, which will get a little bit of attention, and then University of Michigan data. I don't know, Lawrence, how much weight you put on that, but I found the 1-year expected inflation survey from University of Michigan to be quite interesting. That surged not too long ago, up well into the 5s, and now thankfully it's come back down into the 4s. Would love to see that drop further into the 3s, but it's still 4.5.
Yeah, there was another. So there's a lot of different surveys out there that measure inflation expectations as well as market implied inflation expectations. This one has been kind of the outlier, so to speak.
Right.
If you look at just the Fed data, the Fed inflation expectations, which uses a different kind of survey methodology and different people, that's stayed relatively consistent and is in that low 3 numbers. But yeah, you're absolutely right. I mean, we did see a tremendous spike in inflation expectations based upon the University of Michigan survey. It has come down a lot from where it was previously. So yeah, hopefully we continue to see that trend of lower inflation expectations. That would make the Fed's job easier in terms of the ability to cut interest rates. If inflation expectations were unanchored, as they say, that would make the Fed's job even harder than it already is.
Yeah, I think so. Our chief economist, Jeffrey Roach, thinks that we'll probably go up close to 3 on core PCE, which is the Fed's preferred inflation measure, and then start to roll over. So if we could see evidence that rollover is happening by year end, the market will sniff that out and probably will not be too worried about inflation a few months from now. But we're not there yet. I mean, we're barely seeing the uptick. So it seems to me like you have to be a little bit patient before not just the Fed's probably going to cut in September, but to think about more cuts than that, or to think about a scenario where the market doesn't really worry that much about inflation, we're probably still a few months away from that. So I think that's where we're going to end. Thank you, Lawrence, for joining right before you take off for San Diego. So hey, have a great trip out there and a great conference. I'll certainly be watching on the live stream. And for all of you LPL advisors who are listening, thanks for taking time out of your busy conference schedule, happy hours, whatever you're doing out there, meetings, calls. Thanks for squeezing us in. We really appreciate it. Thank you for your support of LPL Market Signals. We will see you next week. Everybody take care.